Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's earnings season review on Tuesday, the 10th of February. Over the next 30 minutes, we'll be looking at what experts have to say about the corporate outlook and how wider domestic and international dynamics might play out into company exec views and expectations for the quarter gone and beyond. I'll be joined by regular expert Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, a TMX company. But before we get into it, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Okay, so Christine, we're a fair way through the current season. What's been your... one of my manners. Hello, how are you?
Hi, Harry. I'm well. Thanks so much for having me.
Always a pleasure. As I said, then we're a fair way through the season. Roughly, we're coming to the, the peak in terms of the earning volume amount of reports we have. What's been your assessment so far?
It's gotten better over the last week. I think the season started out on kind of like a meh note, as far as the number of companies surpassing top and bottom line expectations, but things have really straightened out in the last week or so. Like you said, we're about 60% of the way through S&P 500 reports for the Q4 season. And we're up to 13% earnings growth. And so this would be the fifth consecutive quarter that we've seen double-digit growth on the bottom line, revenue growth of about 8.8% right now. And if you remember, we started the season and expectations for EPS growth were about at 8%. And that was actually high because the sell side were raising estimates coming into the season, which is pretty atypical. We've seen that the last two quarters now. But for the Q4 season, Wall Street lifted estimates by about 0.5%. And so the bar was set a little bit higher. And so we kind of saw that throw some companies off that were, reporting in that early cycle because the bar was higher, they weren't necessarily surpassing it. We always take a look at the beat rate with a grain of salt, though, because, typically something like 80% of companies surpass, which just lets you know that maybe the bar was a little too low. Typically, sell side analysts will lower estimates coming into the season based on corporate earnings guidance, which is always a little conservative. So the beat rate struggled a little bit early on. It was lower than what we've seen in the last 5 and 10-year averages. But as of this latest kind of round of earnings, we've now got 76% of companies beating Wall Street analyst earnings estimates. That's still worse than the 1 in 5 year averages, just slightly, but it's equal to the 10-year average. Similarly, on revenues, we've got 73% of companies beating Wall Street estimates, and that's better than the 1 year and 1, 5, and 10-year averages. So beat rates are getting better. Earnings growth looks very strong. Estimates for next quarter, we're looking at another quarter for Q1 2026 of 11.3% growth on the bottom line. So I'd say all in all, it's shaping up to be a pretty, good earnings season and positive surprises all around.
Okay. If you want to break down the sectors, what sectors do you think have done best? And again, I know we aren't all through the season yet, but the laggards and the outperformers, what's doing well and what's doing not so well?
Yeah, so the leaders are kind of the usual suspects. We've got tech and communication services up there with the highest earnings growth numbers, but also the highest beat percentages. So I think this, as far as sector beat rates are concerned, in communication services, every company that's reported from that sector has beat expectations on the bottom line. For tech, it's 95% have beat. And actually, energy, 90% of energy companies have beaten expectations. And then at the lower end is real estate. And then really the only laggard as far as earnings growth. We've got two negative earnings growers so far. That's healthcare. Their blended growth rate is about negative 0.2% thus far, and consumer discretionary
Mm.
down just less than 1%. So that's at the bottom end, and I say that trend kind of flows through into revenues as well. Information technology leading revenue growth at about 20%, and then you have communication services at 12%. So again, probably no surprises there. We still have 40% of companies to report, so I'll be interested to see if healthcare and consumer discretionary, we're waiting for all the retailers to report. Perhaps if those results come in better than expected, that'll be enough to boost them into the green.
Okay, good to know. I want to get back to the tech sector because, as you've seen it, well, as everyone's seen over the past few weeks, we've had a bit of a meltdown. We're recovering in parts, but ultimately, what you've seen is worries over the spend factor on AI, particularly. I think that is. I want to we'll look at that because I think that's important. We do have non-farm payroll, though. We're recording this on the Tuesday. Non-farm payrolls tomorrow. White House Economic Council Director Kevin Hassett admitted that there could be way lower numbers due to AI productivity. So that's is
Mhm.
potentially weighing on the labour picture. But there's a lot of stories around AI at the moment. It seems it's obviously still the catchphrase of the year so far. But we have seen a bit of a reprieve in indices at the start of the week. Part of that, some say it was down to the corporate uh, news that we've had out into corporate debt news, rather. Google price 100 or put the pricing out for a 100-year bond to fund its AI campaign. How have you interpreted how this has affected the sector and people's thoughts around it? I mean, are you surprised that people are surprised that there's been so much spend on AI and investment in the AI sector?
I was surprised by some of the reactions to the hyperscalers this quarter. We did start to see last quarter investors were looking, a year ago, it was like if you were spending on AI, you got rewarded, right? It was like you were focused on AI. Investors seemed pretty happy that you were allocating cash to that endeavor and you were, investing in the build out. Last quarter, so Q3 earnings came out and there were winners and losers. Investors were kind of deciding who was starting to see the returns. I remember Meta reported CapEx spending was going to be higher than expected and they got punished because, investors felt that they just weren't seeing kind of the results of that spending. Whereas you had other names like Microsoft that were then rewarded for announcing these sort of massive CapEx plans. So certainly, no surprises that that spending was going to increase. You had
Mm,
everyone from Goldman Sachs, all the banks giving their estimates that spending in 2026 was going to top 500 billion. And lo and behold, when the four biggest hyperscalers came out with their capex plans, if you add those together, it's I think over 600 billion. So yeah, maybe a little bit more. I think that's what it came down to. CapEx spending guidance was slightly higher than expected, but again, even that was kind of rumored to be the case, right? So you had Meta reporting, they'll likely spend between 115 to 135 billion.
mm.
Amazon 200 billion, Google 175 to 185, and Microsoft, I think the
Big numbers.
Wall Street, yeah, big over 100 billion, right? So
Mm,
so perhaps that's what caught investors off guard. There's still some opacity and understanding, what the returns are on these investments. But you mentioned all the big debt offerings that we're, starting to hear about as well.
mm,
Google, Oracle. I think last year, Oracle, Google, Microsoft, Meta, and Amazon issued about 120 in corporate bonds. Now you've got more of those announcements happening now. With the
yeah.
Google, that was announced yesterday, and the Oracle debt offering announced last week were both 5 times oversubscribed. So fixed income managers, want a piece of this hyperscaler build out. Um, and
Is it sorry,
that's
just to sorry to talk over you, but is some of this also down to alternative debt portfolio? If we look at the macro picture and we look at what's happened to US denominated assets, and Is there a story in there somewhere, or am I looking into this too deeply where they'll people are happy to invest or happy to lend to the corporate America as opposed to the government? Would that be a story at all, do you think?
Yeah, I mean, sometimes we look at the treasury and corporate bond spreads. The spread is, obviously the wider the spread gets, the little more worried you get. The spread is quite tight right now, or like within historical range. But I think it's just interesting you bring up kind of the alternative. It's really just a buy-in for the corporations. It's another alternative, and it shows like, look, markets loved that Google debt offering, right?
Mm,
So in another way, despite the initial reaction to some of those capex spending plans, you still see support for these efforts in other ways, right?
okay. No, that makes sense. Just a note from Goldman's, we talked about Goldman's Mark Wilson here, just echoing a lot of what you said, really. So the financial profile of the market's largest stocks is shifting fast. Concentration in risk is well known, but the bigger change is that the Mag 7 capex now consumes over 90% of operating cash flow versus heavy buybacks just a year ago, while PE multiples again have derated toward post-COVID lows. Cash flow valuations keep expanding as investment intensity rises. The operating performance remains strong, but this new capex regime forces a rethink of valuation. Now, you answered the question about will this capex earn? Well, we've talked about an attractive return on investment. Does the scale? One of the questions he asks is, does the scale of investment risk erode core profitability? This is something he examines within his note as well, and also says, will capital intensity stay this high for longer than expected? These are sort of questions you're seeing people ask in your day to day conversations with both investors and corporates.
Yeah, I mean, it's the unknown, like he says, and not knowing how long can spending, hit these levels, and at what rate will we start to see returns? I mean, there's a squeeze here, right? Because
Mm,
operating cash flow growth hasn't kept pace. I mean, still quite high. I think right now, if you look at the hyperscalers, operating cash flow growth is probably 20%, but because it hasn't kept pace with capex growth, which has spiked over 50% for some of these names. The kind of residual cash left over for investors is shrinking. I mean, if you listen to Jensen Huang of NVIDIA, he says if you're focused on free cash flow, then you're like missing the big picture, right? That we shouldn't be so focused on that. That we should focus on kind of the future. And but that's the big unknown, right? We're not sure how this pays off. Not even sure in some cases how this all gets built. Like we know, Amazon building these data centers, they're obviously kings of logistics and they know how to build things and they have relationships with municipalities that help them build out these data centers. But there's a lot of question about the labor needed to do so. Who comes in at the end and puts in the electricity, and how is it possible to build at the pace that we're going to need to keep to
mm.
kind of justify some of this capex spending. So again, I think that's why you saw investors retreat a little bit. As you said, we've kind of come back here. But there are some concerns about how this gets done, and what certainly going to be winners and losers, but it's hard to pick them out, this early in the game.
And I guess we're still breaking virgin ground on this at the moment. This is relatively, well, it's not relative. It is new in the sense of this overall investment, and just the players in the game, like you say, are likely to evolve and to change, and that energy dynamic as well, where you're going to get the energy supply
Right.
from. I know people are building their own reactors and so forth now. These big companies because they have the purse to do so, but it's one of those questions that not fully answered yet, I guess.
Yeah, and like Dan Ives from Wedbush always says, he's like, we're at the top of the second inning. We have, like you said, we're not at the very beginning, but we're still pretty early in this. We have, 7 more innings to go to figure this out. So we're still relatively early, but he always compares this to the next big industrial revolution, and it's going to take time to figure out, what the right investments are, and like I said, who the winners are going to be. Um, but we're early stages, and so everyone's kind of placing their bets now, and no one's really quite knows yet who's going to end up benefiting.
For sure. I want to go on to the rest of the earnings. They said we're past the peak now. 70%. Was it 60%? We said nearly
Yeah,
60%.
yeah, we're in the 60s now. Yeah, 60%.
Okay. But we still have some big companies still to report then. What are you focused on for the second half of the season or the final part of the season?
Yeah, I always around this time turn my focus to consumer linked names, whether that be the retailers, which we don't hear from really until next week and the week thereafter. But we've started to hear from, consumer facing names. Just this morning we had results out from Coca Cola, we had results out from Marriott, obviously, two very different companies, but both echoing similar sentiments to what we've seen, where their sort of premium products continue to do well. But demand concerns for kind of lower income shoppers. For example, Coca-Cola saw demand for drinks soften as low income shoppers look to save on grocery bills, but some of their pricier brands like Smart Water have been bright spots. And similar comments we saw earlier this morning from Marriott, that their luxury portfolio remains a powerhouse. RevPAR was rising in that segment, but some of their lower priced options continue to struggle, right? And so that's the story we've heard, that the higher end consumer is still carrying the U.S. economy. They're still shopping, whereas a lower income consumer is still being, pretty conscientious with how they spend and pivoting and making changes with how they would usually spend. We saw some of that too from some of the restaurants, although some of those were more, Chipotle's been kind of struggling a little bit.
Mm.
Um, we're waiting for McDonald's out tomorrow. Surprisingly, Starbucks, Brian Nickel, their CEO, said they are not seeing spending in line with consumer sentiment. So consumer sentiment's been quite low here, but their foot traffic, was kind of went against what some of the consumer sentiment surveys were saying. So Starbucks, but again, that's perhaps considered a higher income product, right? So they're seeing same level of traffic.
Mm.
Um, so we've got more of those names coming out. And then, like I said, we really get into the true retail earnings parade with Walmart next week. The week after, we've got Home Depot, Lowe's, some of the apparel names where you'll, really get more of an idea. But if we needed any sort of kind of early peek at those, we did get retail sales this morning.
Yeah, I was about to bring that up. We did see that. And
Yeah.
apparently, analysts said there was a pause in spending. This is a note from Nationwide Chief Economist Kathy Bostonyak saying that the sales report shows that consumers pause their spending at the end of the holiday season after a strong spending spree in October and November. The stagnant retail sales in December provided a soft handoff to Q1 consumer spending, but we look for a surge in tax refunds. It's estimated to be about 50 billion higher than last year, and still strong wealth effect will buoy consumer spending in Q1. So she seems fairly upbeat that that resilient consumer spend is still there. What are your views on that?
Yeah, and you're totally right. The promotions have been moved so much earlier into October, into November, that
Mm.
we've seen a higher percentage of shoppers scooping up those deals earlier on. And then, like you said, that probably impacts the eventual spending in December. So retail sales came in flat this morning for
Yeah,
December. That was after a 0.6% increase in November. Still, economists expected, or the survey by Dow Jones expected an increase of 0.4%. So, a bit of disappointment there because it did come in lower than expected. On an annual basis, sales rose 2.4%, which failed to keep up with the latest inflation reading. We saw CPI in December came in at 2.7%. So, um, but like you said, we've got a lot of tailwinds coming up with
mm,
tax refunds, which US shoppers tend to see as a windfall, and they usually spend that as discretionary income. So that should certainly help get us through Q1, some of Q2. But yeah, a lot of the same spending patterns. Again, higher income shoppers able to kind of carry the rest, and not quite changing their spending habits while others maybe are trading down. But We've even seen in the higher income cohorts, like when Walmart comes out next week,
Mm,
we'll hear an update from them, but they have grabbed some of that audience as well, right? Because everyone's sort of aware of it, and like you mentioned, we'll also get jobs this week. That is a huge factor in how much folks are willing to spend, right? If they feel like they're safe at their jobs, or if they were to lose a job, they'd be able to get a new one relatively quickly, then they're happy to spend, right? But right now, the ADP numbers that we saw out last week in lieu, we didn't get the jobs number on Friday, so it was kind of all about following the ADP report, and that came in lighter than expected. So
mm,
will be interesting to see what we get in non-farm payrolls. But yeah, private companies added 22,000 positions in January, and the consensus forecast was for 45,000. And so it's still a bit of a lackluster job market. We're in this low hire, low fire environment. Not a lot of people, if you look at quits ratios and who's willing to jump jobs, it's certainly fallen from what we saw maybe a couple years ago.
yeah. I mean, the underlying picture for retail sales, pretty much average annualized control group sales dropped to 2.6%. That's versus 6.4% seen in September. Analysts are just implying this means a pullback in personal consumption during the Q4 period. And it's like you say, it's unbalanced in the sense that you've got the higher earners taking the slack for lower income at the moment, and that's at some point either that corrects or it blows out, and we get further imbalances. So it's going to be interesting to see how that affects obviously corporate intentions down the line, and like you say, next week we'll get some of the big consumer outlets like the Walmarts um, to report, and will obviously they have quite a good gauge of overall spend, aren't they? Generally speaking, there people do look at the Walmart figures and for some sort of guidance, don't they?
Yeah, I mean they're really the bellwether in the
Hmm.
retail space, the
That's the
biggest
word I was
retailer in
looking
the
for.
world. Yep, yep. They kind of set the tone for how people believe other retailers will report throughout the season, and it's interesting because they really are we always call them a one-stop shop. So you're getting both kind of a consumer staples angle because their grocery business is huge, and that's really what has helped them through the last year as folks have been really price conscious and maybe focusing more on necessities. It's like you go there for the necessities, you stick around to buy the discretionary items, so they end up kind of winning on both in both of those
Sure.
segments. And everyday low prices, they certainly outprice their competitors, and so that keeps their shoppers happy. But yeah, they are the bellwether. They are really the barometer for consumer health in the US.
Okay, excellent. We're coming nearer the end of the episode now. As I said, we do have a non-farm payroll data for January. It's kind of looking in the rear view mirror, but there are annual reviews to come through, revisions as well, sorry, to come through for tomorrow's Labour report. And we'll see how much, I guess, we're affected by this partial government shutdown, if it affected collation at all. I doubt it, because it would have been maybe they'd have collected a lot of that data, collected a lot of that data already, but it's one to watch. But we did see a rise in job layoff announcements and lower job openings data, which some say Oxford Economics says has fueled another wave of anxiety over the health of the economy. Against that, though, we're seeing expectations for maybe near-term growth picking up slightly. So, yeah, there's a lot to look out for there in the coming weeks and months of this quarter and into Q2. Christine, I'd like to thank you very much for your participation today. Thank you for your insights, because they're always valuable.
Yeah, thank you so much for having me. Always so fun to chat. We'll see. We got a big week, like you said, and so we'll see how some of these numbers come out, and um, what's said about the job market and impact of AI, which I know is top of adding to everyone's anxiety. But we'll get a lot of great data this week and next.
Yes, it will be. It will be interesting. Yeah, so thank you again. Anyway, thank you for everyone for listening. If you've missed the start of this episode, you can go back on the podcast channels and catch up or onto the social medias on X or LinkedIn or YouTube, wherever you may consume your podcast or your broadcast, whatever. But again, thank you for listening. Thank you, Christine. And we'll see you guys again later in the week for a roundup of this week's key data. I know we've got inflation data out as well. It's a busy week for key US data. So we've got CPI data out this week as well to keep an eye out for. So yes, have a great trading week, and we'll see you all again soon. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.